Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me is Phil Mackintosh, Chief Economist at Nasdaq, for an update on the latest COVID-19 news, the U.S. and global economies, and how markets are digesting the progress of reopening the economy. And this morning, we'll take a look at slicing Apple and the impact to the Dow, as well as the rebound in IPO activity. But Phil, let's review last week's trading activity and sort of how we ended the month, which really looked to be very range-bound.
Yeah, I mean, it kind of looks like the market went up and then down and up and down, but it really didn't move much all week, and it only ended slightly higher than it started, which has kind of been a trend for a lot of the weeks recently. I guess the news on COVID back in March was all bad, and then the news in April, May was so much better than expected that a lot of the rally is already priced in. And even though it's reported that July was one of the strongest Julys in the last 10 years, it wasn't that strong a month, and that's because a lot of the markets are waiting for really good new news, whether it's vaccines or just to see how these second waves are going to start to play out.
Let's take a look at our latest COVID-19 data, and it seems to be that U.S. cases have peaked, but Phil, I mean, we're still surpassing 18 million on Monday. This is still pretty contagious and out there.
Yeah, and you can actually see the contagion happening now back around other countries in the world. So although it looks like we've got our southwestern states under control, we've talked last week about how that's not the case with some of the northern and midwestern states now, and Alaska is starting to see an uptick. But also in Europe, which we've been quite positively watching because they managed to reopen their economies back in April pretty successfully. There's a bunch of countries seeing an uptick in cases now, from Germany to Spain and even Austria. And it's not nearly the scale of America, so we're still seeing 60 to 70,000 cases a day. They're seeing about 6,000 cases a day, but it's a significant uptick from where they were. So to your point, it just proves how contagious this is once you relax a little bit. Japan's also seeing an uptick, and there's been a lot of talk about Australia with Melbourne and the state of Victoria going back into lockdown. So it's definitely not gone. It's just that we've learned better how to control it. But we have a while to go until I think the vaccines are going to be ready for everybody to take.
Let's talk about the stock split, the 4-for-1 stock split of Apple. I thought that was some of the more exciting news that we've seen over the summer, as fractional shares have become so popular. But it's actually an anomaly for larger companies in particular to split their stock.
Yeah, that's true. I mean, stock splits were pretty common all the way from about 1930 through to about 2005. And if you looked at the average price of a stock, it was always around about $35, $40 throughout those decades. And then all of a sudden, we saw stock splits pretty close to dry up. They've become far less popular lately with the automation of markets. And that's not necessarily a good thing for stocks. There's quite a lot of academic studies that prove that if your stock is too high priced or too low priced, its tradability suffers, which makes its trading costs go up, which makes actually the value of the stock go slightly down. So the fact that Apple has done a stock split, historically, companies that have split back to better tradability prices have seen their stock rally around about 2.5% between the announcement and the actual split date, because the markets know this is good for trading. And then in the next 12 months, they rally another 2.5%, or outperform, I should say, by another 2.5%. So 5% outperformance all told, just for making your stock cheaper to trade for investors. So it should be a good thing for Apple. And it'd be nice to see all companies with better tradability. There's a whole lot of market structure problems that high-priced and low-priced stocks create. On the high-price side, you end up with a whole lot of very small trades in terms of the share counts inside what's the public quote. So odd lots, and really difficult to do best X, what looks like a wider spread than is really available. And on the low-price side, you actually have quite expensive spreads to cross, and a lot more hidden trading because of that. So Apple's ideal price is probably around about $100, $125, and that's exactly where they've gone back to. So they should have a really tight spread, and they're already one of the most liquid stocks in the market. So that's good for investors.
What does it mean to the Dow Jones Industrial Average? How does this impact indexes?
Interesting question. So it's not going to impact most indexes at all. For most investors, they're going to have 4 times as much stock and a quarter of the price. So net, there's no real change to how you hold the stock, and most indexes are going to work that way as well. But the Dow Jones it's got so much history. It was invented back in the early 1900s when you didn't have calculators. And so the easiest way to work out whether the market was up or down was just to add up the share prices of a bunch of stocks. and it still works that way. So basically, if Apple's a $400 stock and it goes up 10%, it goes up $40. With a stock split, if it's a $100 stock and it goes up 10%, it's going to go up $10. So it's going to have a much smaller impact in what happens to the Dow Jones returns. And the Wall Street Journal this morning had a pretty interesting chart just showing how much lower the Dow Jones would be if it didn't have the old Apple, the current Apple stock price in it, and it had the new Apple stock price. Because Apple's had such good performance, it's a new economy stock, it's helped the Dow along quite a lot in the last sort of 4 or 5 months during coronavirus.
And let's take a look at our top 25 ETFs this week. That metals trade, it's still seeing the inflows.
Pretty amazing, isn't it? And I guess that's because gold back on Friday actually did hit over $2,000 an ounce. So it kept rallying. And you can see gold, silver, a lot of the precious metals, also through to mining, just all the way through our top 25 list with lots of activity, inflows, pretty good value traded and pretty good returns. So yeah, the precious metal trade continued from the week before. But also there's a few new economy stocks coming into here. You've got some tech sector, some semiconductor, even some software stock ETFs in there again. So you've got that new economy trade coming back a bit as well. The only other thing that's worth highlighting, I think, is Europe and Japan. We actually, as we talked about, are seeing an increase in new coronavirus cases, and ETFs representing those countries saw outflows and they saw the prices come down. So rotation in the ETF world out of those spaces as well.
And Phil, let's finally wrap up with the IPO rebound that we've seen following the COVID-19 shutdowns.
Yeah, so the IPOs have been actually pretty strong in the market since we had a little pause during March, April, which you'd expect. You typically see IPOs fall significantly when the volatility spikes. But now that the market's back on track, we've seen a lot of companies coming to market. It's been a pretty busy IPO pipeline. But this chart's kind of interesting. It shows that the Chinese exchanges are actually pretty competitive in terms of how much capital they're bringing to market compared to the sort of two big US ones. And that's really all that ranks in this chart. So yeah, Nasdaq's over $20 billion brought to market so far this year. But the Chinese markets, including Hong Kong, which is down a lot, obviously, on some of the political changes that are happening there, probably more than anything else. But all of the Chinese markets are hot on our heels.
All right, Phil, as always, thanks so much for joining us on Trade Talks.
You're welcome, Jill.
And thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.